All right. Hi, everyone. So, we're doing this live stream to talk about the most recent announcement by the Bank of Jamaica in terms of interest rates going down by 25 basis points. I thought it was an interesting to cover because as I've been working with some of my clients in terms of our coaching, where we're looking at um, some investment strategies, and I thought this would be a good topic to pull out of some of the things I've been, talking to them about in terms of their investment strategies, etc. And of course, I haven't done a live stream in a minute, so I thought it'd be a good topic because I think we're at an interesting time where as we're seeing interest rates go down, we're waiting for the market to respond. We're waiting for loan rates to come down. We're waiting for maybe some other things, right? So let's see how this conversation goes with some good friends of mine. So I have Dr. Matthew Preston and then David Rose, persons who you should know very well. They need no introduction. So how are you doing, guys?
Tired.
Yeah, same. It's just past my
Yeah.
bedtime.
Oh, I'm sorry, guys. I'm sorry, guys. So because I'm back in the working world, we're gonna have a lot of late streams. So for those who don't know, I'll have another stream where I explain what I'm doing now. But
Hmm.
I have I'm no longer CEO of Learn Grow Invest. That is now Renee's role. So I'm now a director, and so Renee is leading our company, and so I'm still a financial coach. I still do trainings, etc. But as I said, this is not the forum for it. I'll do that in a separate video. All right, guys. So um, this specific stream is about interest rates going down. So David, this is your launch point in terms of just giving us the background for this, and then we'll talk about how we're seeing this in terms of impact. So David, you can go, and then Matthew, you can let me know what your thoughts are on what's been happening.
So how you want to start it, Jeremy? Just give some synopsis or context.
Yeah, for sure.
All right. So what we would have seen over the last 3 years, would have been a tightening in monetary policy by different global central banks. Now, why do central banks adjust, interest rates or monetary policy? So most central banks have a particular role. It's something called financial stability. So the basic aim is to make sure that hey, the exchange rate doesn't go out of whack. Inflation doesn't deviate too far from the mandated range. You know, there is confidence in the system, there is some level of stability. So price stability, monetary system, financial sector stability, all these factors, are part of central bank's remit. And to basically keep it simple and give some context, in effect, we have seen BOJ started to increase interest in 2021, and they would have started to cut rates, last month, which would have been August. Not last month, but August, actually, August 2020, I believe. So, what does that mean? So, BOJ has to cut rates, and we also saw the US Federal Reserve had to cut rates. What that means is that in the money markets, you're seeing rates come down. So, just to give a quick synopsis, for persons who would have been participating in the BOJ's 30-day certificate deposits, we can go back to the August 7 auction, whereby in that auction, the CD fixed rate was 7.5%, but average yield for successfully allocated bids was 9%, right? Then the BOJ would have cut rates effective August 22, right? August 21, 22, right? So basically, we would have seen the BOJ cut that fixed rate from 7.5% 7.25%, and the average yield for that auction was 7.99%. And the BOJ have cut rates, effective October 1. And in that auction, the BOJ's, average yield went on 6.65%. So because rates are coming down, in effect, money market rates are also coming down. So what happens when money market rates come down? For one, when the money market rates, in this case the BOJ CD rates, are going up, it created competition for money. What is competition for money? So keep it simple. For some of us who have a good amount of wealth, what we tend to do is that we tend to put our money in the repo facilities with some of our brokers. When the BOJ's certificate deposit rate was going up quite aggressively, what happened was that the brokers would have had to adjust the repo rates upwards to attract a similar amount of capital vis-a-vis the BOJ. So as a result, it would have resulted in the interest expense line for the brokers, for example, to go up. On the other hand, when it comes to the commercial banks, they would have been seeing higher funding costs depending on how their funding structure is set up. So for most banks, deposits are the cheapest source of funding. Some banks also have their purchase agreements. They might have external debt funded by their parent company. They might, do securitized transactions, but basically their cost of funding would have gone up. So as a result, they would have had to adjust their rates upwards as well. So that's what happened when rates would have gone up, basically. With the risk coming down now, on the securities dealer side, they can start to adjust their repo rates a little bit downwards now, which will reduce that interest expense, which means that there's going to be a larger net interest income spread and margin as well. So basically, that's the perspective from the securities dealer side, because interest rates move much quicker to the money markets before the rest of the system. So what about the bank side now? That's what everybody's like, that's what I want to know, because should I buy my house now? Should I, rush in to get any asset I need to get now? And the thing is, it depends, because I cannot find the paper right now to show you guys, but Kirk Douglas works at Arita. He written a paper about it, and there are other publications that speak to this phenomena. What phenomena am I talking about? So basically, they're in terms of actual application, not necessarily just theory. When interest rates go up, you tend to see a quick repricing of assets where possible. In this case, you'd have seen the bank send letters or emails to you saying, hey, we're adjusting your rates on your loan and your higher.
Not yet. I haven't seen those yet, but I'm waiting for it.
You're blessed. But persons, for example, would have seen, their mortgage rates go from 6.5%, for example, to 9% over these last 2-3 years. Now, for some banks, they wouldn't have passed all of those increases on at one time. They'd have absorbed some of those increases for some time. And when rates are coming down, the banking system has a very, sometimes big or slow, fast or slow lag in how those reduction in interest rates are passed through to the system and into the consumer. So what do I mean by that? So basically, let us say the parent company of a bank decided to go and borrow some money to facilitate the growth of that bank, right? Let us say the bank's parent company borrowed at 10% interest rate, right? And that rate is fixed for the next 3 years. The bank cannot just quickly say, hey, we're going to cut rates, because rates are coming down and our customers would like cheaper rates. The bank could have locked in a fixed rate for 10% for 3 years. And until that, that debt instrument, rolls off and comes at a cheaper rate, the banks won't automatically just, cut rates like that. So what you're going to likely see, and this is from historical precedents as well, you're going to see a slow decline in rates on the banking side. So That's a good and a bad thing. Why is it a good thing? For some banks, they have taken a beating during the rapid increase in interest rates. So this is a kind of a way for them to kind of recover some of that lost margin they'd have lost over 2 or 3 years. And it's all for them to generate, some level of high interest income. And in turn, the bad thing is it means that some things that companies will have delayed, persons that have delayed, might get a little bit longer. What do I mean by that? So some companies have delayed their projects, probably capital expenditure, because the cost of money was just too high. And if it's taking a little bit longer for these rates to come down, you have two things that might happen. The company might say, all right, we know rates are coming down, which is good. So let's just bite the bullet, borrow the money now, refinance it if anything. Or in the entity says, we're going to watch a little bit more, see what's happening before we make the big move. So
Yeah.
that's
So
where. Go ahead, Jermaine.
yeah. So Matthew, I want to hear your thoughts before I go where I want us. So there are three areas I want us to look at this from. But Matthew, you go, and then I'll introduce the three questions, because I want those three questions to be the sections that we slice this matter from. So go ahead, Matthew.
Okay,
Or Dr.
thank you.
Matthew, sorry.
Yeah, big up David. You did a good job explaining that. My view on the whole interest rates thing is that, at the end of the day, as an investor, you can't, control interest rates. I mean, sometimes you can make some sort of prediction, because if you look at with Jamaica reducing the interest rates, I don't think it was hard to see, because a lot of other central banks were reducing interest rates ahead of Jamaica. And also the Bank of Jamaica actually tells you some of the things that they look at in making the adjustment to the interest rate. And also there's always that balance, because yes, to try to curb inflation or reduce inflation, you want to raise interest rates, but then raising interest rates can start to slow down the economy, so you can't really do it forever. But I think the most important thing as a investor is try not to like some people may say, oh, I'm going to wait for the interest rates to go down to then start buying stocks, or things like that. But at the end of the day, I think I wouldn't say like someone should stop investing when interest rates go down. It's just, or go up. It's like you just have to kind of change your strategy somewhat sometimes. But at the end of the day, you still want to just, if you're buying stocks, just buy a business for less than it's worth, or but less than you think it's worth. At the end of the day, whether interest rates are high or low, I still think that in the end you still win. So yeah, I mean, I do expect.
So you're saying looking for value is still the best bet?
Yeah, that's my personal view. But yeah. Mm-hmm.
Okay. Yeah. So I'll say from my side, the part that I look at, so I did notice when they just started increasing rates, there was that delayed effect. Because I remember when they were going up, when the rates were going up, the BOJ was concerned that the banks, I think I saw an article or two that said, they're waiting for this to actually reflect on the bank side. And it's that the banks were waiting because they didn't want to be the first one to raise the rates. And then we started to hear one and then the other, and then everybody kind of followed suit. And so I imagine that now that we're in the reverse, it's going to be a similar case where when a bank disperses a loan, they would have a projection for that income from the loan at the rate that they would have agreed on with that client. And that's also why with most banks, you have to give them notice if you're going to pay that loan down early, right? As annoying as that is to me that you have to do that, that's usually how it works. I do agree that so for me, the mindset and so the title of the stream is, interest rates are going down, what should you do? I'll kind of give it away 15 minutes in that you really should be investing throughout, right? No matter the climate, season, situation. It's just more about how you invest. That should be different depending on the season or whatever is happening externally. Um, so for me, the focus for the last 2 to 3 years, I've said it here before, I've been focused on the companies that generate good cash and are paying out good cash, right? That's no secret. That's why dividend stocks are very attractive to me right now. My initial thought, right, and I'll kind of share the first question that I have to share in terms of where I want us to discuss first is what does this mean for the investor, right? That's like the first thing I'm thinking about. What does this, what do the last two rate decreases mean for the investor? So I'll start off since I'm already on the floor. I think that it means that you should start to prepare for what's to come. Meaning we saw where it was a delayed reaction before, we can expect a delayed reaction now. But that doesn't mean that you wait. It means that you start to prepare your strategy for what you know is coming 3 months from now, 6 months from now, 12 months from now, because that's where the opportunities are. I think that it's a great time when I look at certain companies that are at some ridiculously low prices. You really have so many options to choose from in terms of if your timeline is 12 months or more, you will have a lot of choices. If your timeline is 12 months or less, you have fewer choices, but you still have good choices. All right, so as Shelly is saying, nothing will change anytime soon. It's basically them making less money, where shareholders that want high profit. So Shelly, yes, I agree with you, but I still say that's where the opportunity is, because the ones not making, so the banks, for example. So I've been waiting for the cue to me that the market has recovered will be the financial sector. I think everybody agrees with that. So the cue, because that's what we've seen in the last 4 years, the financial stocks have not done well. So to me, the cue that the market is back is the financial sector doing well. And I think the financial stocks doing well will be as a result of the financial sector doing well. And I think that should make sense as well, right? Because we're not going to, that same point Shelly's making about profits, until we start to see, because there's a company, I won't mention any names now, but there's a company that their profits have pretty much been down maybe 75% compared to 4 years ago. I say, Matthew, you're thinking about the company, don't say the name, please. So we've seen that in the financial sector, they're not making the same amount of profits they used to. But that will change, because as interest rates go down, it's lower, it costs less to borrow. Businesses find it more appealing to borrow. They invest in getting capital to grow their business. Persons are able to, for example, spend more because costs may be lower. It drives the economy. The economy is growing, then businesses are growing, profits are growing, stock prices are going through the roof. That's kind of what you're waiting for. But if you have the cash, I think it's a good opportunity for you. So that's my start to the question, what does it mean for the investor? So, how do you guys want to chime in on that?
So I think I can chime in now. And the truth of the matter is, you're likely going to see an expansion in profits, barring any other, I should say, negative
External
factors.
factor, yeah.
Yeah, that drags the macroeconomy. Because one thing we need to remember is that unless a company is highly outside of Jamaica, meaning most of their business outside of Jamaica, the reduction in interest rates doesn't mean much if the overall economy is still struggling. So what do I mean by that? So companies don't operate in isolation. If there's a slowing economic activity or a certain business, then they're going to earn less in revenue and potentially less in profit, especially if expenses have increased. So, for example, over the last year, there have been a massive increase in security costs for banks and for just regular companies by much as 30, 40, 50%. Now, that might not be much for some companies. It's not an operational expense. Other companies was quite material. So, all I'm pointing out is really that, reduction in rates is good because it creates a space for liquidity to start to return to the market. However, it also will be subject to other factors that you cannot control. Because what do I mean by that? So the financial companies will benefit in a scenario whereby their interest expense is falling much faster than their interest income is growing. Because if interest rate is flat or it's not growing, but interest income is growing much faster, perfect. But as I said, everything is in tandem because, for example, the insurance companies would have benefited tremendously from higher rates. Why? They would have invested their money into higher rated instruments, meaning higher interest rate fixed income instruments and more investment income. So with that reduction in that stability of income, these firms are not going to have to be seeking or searching for similar assets to give a stronger alpha or return in the coming years. So it's a good thing in the sense that we're like going to see more IPOs in short order because the valuations of these companies would be more attractive to prospective investors who would have been more attracted towards fixed income. But everything is still subject to external factors in the general economy if this business operates made in Jamaica. If it operates externally outside of Jamaica, like in probably USA, Caribbean, and so forth, it's a different story.
Matthew, anything?
I'd say something else to tie in David's one of the points David made is that with the junior market limit being raised, like it's supposed to be raised possibly this year or maybe early next
That's
year.
still happening this year. The timelines for me, I'm not.
So, well, we spoke to the chairman of the Jamaica Stock Exchange on one of our episodes, and he said
Share
that
that
it
link for
should
me.
still.
I'll link that below the video. Share that.
Yeah, so
Whatever you can, I'll post it afterward.
yeah, so he had said that he's still hoping, based on what he's been hearing or whatnot, it should still be this year. So I think that tied to what David was saying, that essentially, people who are going after low risk investments, because they were getting almost a guaranteed return, they're like, hey,
Yeah.
we can get this good return on our capital. Why should I buy a stock which the business could go, bankrupt? Versus now, okay, I don't have a choice. I'm kind of going to have to allocate some of this money towards stocks.
It's not that I don't have a choice, but my options are limited
in
terms of attractive returns.
Yeah. So I think that would be interesting. So the junior market limit got raised from 500 million to 750 million. So
Hasn't been raised as yet.
Or is to be raised, I should say. Sorry. So yeah, I think that'll be interesting to see.
So I'm thinking that, so I said it before that I think in terms of what it means for the investor, I've been kind of, and David, you and I have been having this conversation privately for months, cash preservation, being mindful of how much cash we have. And I think the dividend plays have been very safe. Like again, I'm trying not to call any names here, but you had, the companies that have been paying dividends. If you look at the performance after dividend consideration, dividend announcement, dividend capture play has been a very real one over the last couple of years. I think that will change soon. Only as let's say as the prices go up, the yields are gonna go down. So those stocks that are attractive in terms of yield now, I mean, Dolphin Cove was 10%. I don't know, but I haven't announced any this quarter. But let's say that they maintain that 10%. The price is around $22, $23. If the price is $40 and the dividend remain the same, that yield is gonna get cut in half. That's not gonna look as attractive as before. Now the 5% may actually be still high compared to the market average, because unfortunately the JSE average for dividends is only 1 to 2%, which drives me crazy. But that's another conversation, right? Because if you can't pay a healthy dividend, don't pay one. Is my opinion. But yeah. So let me bring in the next question, and then we can kind of tie everything together.
Remember that
So my next
1%, a yield of 1% for you, maybe like 10% for someone else, and they're happy with
But
that.
so yield is dependent on the price you pay. I'm just saying, for if it's a top 10 shareholder who has been there since the company has been listed, their yield is ridiculous, right?
I
I'm
mean, it's their
saying for
company
those
though. You
who
can
are
sell.
entering the market, right? Um, so my next question is, what does this mean for the market overall, right? So I don't know who wants to take that one first.
So I guess I can go first, but I can answer it in the prior question, that you're going to have companies that would have been delaying their equity offerings coming to market now, because to put it into perspective, right? It works a bit for a company to have a big bang of its IPO, meaning that it's heavily oversubscribed. The stock price is up probably 100, 200% at the day after trading, because it's easier for that momentum to be sustained, and there's relatively, tight ownership as well. So it works with everybody. And the thing is, we would have recalled, Jamaican teas, restructuring their business to become a holding company, and they intend to list in their manufacturing mills on the JSE, which, if they can list in the main market and they're able to actually list it at a better valuation, that means that they're able to actually issue less shares to the market, and get more capital and retain more ownership. So for the overall market, it's going to really come down to, the institutional investors, and also, I believe, the retail market having some level of heavy skepticism again in the stock exchange or the stock market, because 2019, 2022 were quite significant years. There's a market participation with the reduction in prices. I've heard it as well, that the person, saw the prices of stocks going down. They didn't know how to navigate, those price reductions, and they just did not open their portfolio. So there's some persons right now, they just open a portfolio and say, oh, big loss, close it back. So the psychology likely might change again if you're starting to see more trades and more value on the market, because we're still so much behind last year just the value traded. It's going to be a little bit more because of recent trades like Wisynco, AS and so forth. But the truth of the matter is, the return of the retail investor will drive greater value in the market. So if the regular investor, who potentially didn't take advantage of this high interest rate time, but because they couldn't afford it, or they didn't see the value of locking their money up in a sense in some instruments for an extended period of time, they might find preference with, the stock exchange, or in this case, the stock market, as an avenue to grow capital again. Because the truth of the matter is, times are relatively tough for a lot of people. So the stock exchange, although it has some risk, like in other investment, does carry a greater potential for higher returns.
Hmm. Yeah, I mean, I think it will be good for the overall markets. As we mentioned before, we're gonna see more IPOs, more secondary offerings, which tend to bring a lot of new investors to the market, one of the things that's, I guess, funny about stocks is that people tend to go or tend to look towards buying stocks when the stocks are, going up. But you really should actually be looking more at it when the stocks are going down, but the business is still performing the same or better. So I think with a lot of the, David mentioned 100%, 200% IPOs day one, well, the first week of trading, shooting up in price, that tends to make the headlines. More people get or interested in stocks and they say, hey, my friend made this money on the market. I want to make some money too. I just hope that they stay after, that they don't just go IPO and then, like, remember guys, like at the end of the day, you can't just wait for the IPOs, because when there's no IPOs, like there haven't really been many IPOs over the last year, if you are only investing in IPOs, you're just not doing anything with your money possibly. I don't know if you're just holding it in cash. But yeah, I think overall it's going to be good for the markets. Companies, eventually when the loan rates go down, companies will be able to borrow for, less money. So it'll make it more feasible to do their projects, expand their businesses. So yeah.
Yeah, so it will also be cheaper for like raw materials. It may be cheaper for getting in goods. It should be less expensive to do business overall, because it really, most persons think the interest rates are kind of, abstract or maybe specific to certain things, but it really touches on everything in the economy.
So
You can, yeah, go ahead, David.
just a quick point to basically give some quick context as to why rates going down is a good thing. So when you go to the bank, for example, right, they are going to calculate your affordability of any financing product. When rates are higher, it discounts a larger percentage of the population from potentially taking on a particular form of financing. So we'd have heard that the mortgage disbursement in the last couple months has gone down, because even if I earn a good salary, use NHD for example, if the rate is just too high, the bank cannot or will not likely disperse that loan to me, because they are able to have to extend the tenure of the mortgage probably to 40 years instead of 30 years, or just extend altogether. And the thing is, it's not going to potentially be in your best interest, because we would have seen over the last couple of years, banks would have raised the rates on mortgages and other things, and the mortgage going by extra 30 grand a month is pretty heavy. So
Yes.
you're having your salary increase to that degree, and also you'd have seen property insurance go up quite aggressively as well. And now we saw this year motor insurance going up. So the reduction in interest rates creates great affordability to more people to use financing for their personal needs. So that's the major benefit to consumers when rates do come down and the banks do adjust their rates accordingly.
Yes, I've heard some of the mortgages that are out there, and so the cost of properties were going up because, again, if you think about it, if the developers have to pay more to build the properties because raw materials were going up, their finance costs are higher to build the property, therefore the unit cost of each of the units being sold is going to be higher. If you pay higher to build it, it's going to be priced higher. If it's priced higher when you purchase it, even as an investment property or an Airbnb or whatever, you have to rent it at a higher rate. Again, it just impacts everything across the board. And so rates going down is good. Of course, we can. It's like gas prices, right? When gas prices go down, we don't always see it reflecting the pumps right away, unless it's going down like consecutive weeks for like a couple of months, right? But if the prices go up, we're likely to see it in the pump the very next day. So it's like that in a sense, but still overall good. My concern is that I'd say, well, focusing on the question, which is what it means for the market, I think it will be good. I think it would be good to see more participation. Participation is still low. We see that in terms of the income from the brokers now. So the banks who are brokers, we see that trading fee income has been down. or fee income rather, right? So that going up is good. More investors in the market is actually good for seasoned investors, right? So all the persons like Matthew who can take advantage of the inexperienced investors who, as he said, is buying when the prices are going up, right? I mean, if you're buying when the price is going up, that means you're projecting it to go higher. Nothing wrong with that. But overall, that type of activity in general, it increases liquidity. It's favorable for prices and overall sentiment of the market, and it's what you live for as an investor, right? So my final question in terms of what I wanted to raise here, and then we can kind of see where the discussion goes, is what should our portfolios look like? So this is not a stocks to watch. And Matthew, don't give us any disclaimer because that you're not a licensed financial advisor. We're talking more about industries now. We're not talking specifics. So what should our portfolios look like?
So to give context, and it kind of came up in the beginning of the session where I was discussing the BOJ CD rates. You want to capture these higher rates if your portfolio and your income band allows you to do it. Why do I say this? So, for argument's sake, right? Let us say an investment is maturing within 1 year and it's offering 10.5% for the interest rate. You need to account for the withholding tax, which is 25% on interest. You're still probably around 9%, over 8% in terms of your return. So yeah, 7.875%. But what I'm trying to highlight is that you are not going to likely find that in the banks, because even rates are going up. The only bank that I saw that was giving potentially those kind of rates was JMB Bank. And it's not me saying it off of preference or anything like that. The BOJ published data to say, hey, these are the averages across banks. JMB Bank's rate sheet. If you had over $5 million and above, they were giving you 5% of your money as interest. Even though that was interest was paid quarterly, still pretty good. And some of the rates are likely to come down as rates come down as well. So, personally, I can take advantage of this opportunity, to buy some, assets that are heavily discounted can potentially benefit, because this is kind of where theory and reality kind of, collide or meet. And let me explain what I mean by that. So if interest rates are going down, right, what is going to happen to the value of my existing fixed income instrument or investment as well issued at a higher rate? Somebody's actually going to try and buy it from me at a higher price because they want to lock in that higher rate for the period that the bond or fixed income instrument is going to be an issue. So when rates are going up, all the other instruments that were issued at lower rates were losing value. All these higher rated instruments that are already issued and rates are coming down, they're likely to go up in value. So for some persons, that might mean, when they get these instruments, potentially $90 or 90 cents on every dollar, or just a discount relative to par, and they're holding these instruments, for a short period of time, probably a year, 6 months, whatever, you're still getting a pretty decent return once the company is able to, properly refinance or just pay back in full for that fixed income instrument. With respect to the equity side, you're going to have to be very deliberate and careful. Let me tell you why I say that. On the JSE, we tend to see that the financial sector takes more precedence in Jamaica based on how our economy is structured. Our economy is mainly service-based. So your economy is mainly service-based, and you have the very few what you call high-income drivers in your economy are not really listed. So apart from a CPJ or a Dolphin Cove or Everything Fresh, you do have many companies that are in the exposure to the tourism or hospitality sector. So you tend to see that the financial companies are always accelerating quite quickly when rates come down quite aggressively. So in 2019, for example, we saw Sajid go from $40 to $80. We saw JB from $30 to $50. We would have seen NTU from 140 to 150 to 220. You would have just seen so many companies, rapidly increasing, or particularly in the financial sector, like even the JSP from $19, $30. But the reason I mentioned some of these things need to be very careful is because that rapid increase in the values of some of these financial companies is likely going to be lagged similarly to the recovery or expanded economic activity in the economy. The manufacturers, while they're not as sexy, they're benefiting from, so some of them are benefiting by the expanded capacity they'd have taken on over these last 2-3 years in anticipation of increased demand for not just export market but for the domestic market. So we'd have seen Wilson increases capacity by 50% to not just service the domestic market to come in full, but also give itself the potential and space to really grow its export business. We'd have seen that's manufacturing, mentioned here. We're basically going to be increasing their production capacity by 40%. Those stocks don't always tend to get the same level of love or attention, but we've seen last year, we ran like $5 this year to $7.
That's a big deal, by the way.
Yeah. So I'm just showing you that, and that's still growing. That's manufacturing still growing aggressively in terms of the income and revenue and all those other figures. So I'm just pointing that you're likely going to see that lag in terms of the reduction in rates really translate into some of these financial companies. So you have to really look and diversify your way around. So we're seeing a TJH, we're seeing a FESCO, we're seeing all these different sector-based companies and the JSC coming up. And these companies are growing quite aggressively through taking on debt and other forms of capital to build the business divisions. So some companies, but they're not directly tied aggressively towards interest rates on one hand, because of how they're structuring their growth prospects, their stock price can easily go up by an extra 100-200% within the next 2 or 3 years, because a lot of the Jamaican companies right now, not most, but a lot of them are trading the IPO price.
Yeah.
Some of them for fundamental reasons, others just because people wanted liquidity and had to sell their shares to get cash.
Yeah. So don't move on from that point yet, David, because I want people to have an appreciation for that. I don't think persons have really realized that the market, a lot of the companies that they see the price is going down for, it's not a reflection on the performance of the company, but actually the strain on liquidity for the persons who are holding the stock price, who are holding the stock. So it can be that, let's say a company has 4,000 investors, but 100 people, 200 of them need cash. They're going to sell for the best price that they can sell for. That may bring down the price in the short term. It doesn't mean that the investors or majority of the investors are going anywhere or have gone anywhere. And what that presents is an opportunity, which is why I think, going back to Matthew's earlier point, value investing in terms of seeing a company that are actually valuable in every sense of the word is going to be key right now. Because what I think is going to happen is that for those companies that you are absolutely certain, like by every single measure that you can use, that are undervalued right now, those companies are going to be even more attractive, especially if they've been making moves to increase their revenues and profits, right? Those that have been doing acquisitions, those that have been doing consolidation, those that have been investing in infrastructure, they're going to be extremely attractive 2 to 3 years from now when everything is recovered. They're going to be making even more than they're making now. And that's when you're going to hear people start saying, I wish I had bought, or the price is, so high now, etc. Right? So, yeah.
And just a little point to add in, Jeremy, in the US markets, just from the reduction in rates by the Fed already, we're seeing a lot of companies have a rapid expansion in their stock prices. So for example, Meta, Facebook, Instagram, WhatsApp, it traded at a new all-time high today. I think it's up probably almost 200% year to date. And earlier this week, I would have rebalanced part of my portfolio up there. So one of my defensive stocks, I saw Meta and a couple of stocks, take a dive. I had my price alerts, got Meta 572, it's at 595 now. So it's a decent gain already, but I'm just pointing out that, the markets might move fast or they might move slow, but you have to position yourself from early to take advantage of those events. Because the truth of the matter is, cheap prices don't always last forever, but at the same time, as I was saying to Jermaine, you have to be pragmatic. So when I was always saying, hey, make sure you have liquidity, is because in these times, if you don't have the cash, you can't take advantage of the deals. And that's just, why I say liquidity is also an important part of, portfolio management. You can take out a margin loan, but if the margin cost is pretty high in terms of interest cost, you might be net negative depending on your holding period of some of these positions. But if you have the liquidity being built up over time, you can build positions when the companies very cheaply. And as price increases, you can borrow against these companies or use a portion of your shares to borrow at a cheaper price. So for some persons, for example, they got in CPJ cheaply in 2021, whereas if they rapidly increased going into 2022, and they would have basically, been able to take a margin loan and pledge a lot less shares than if the company price had stayed the same. So just do food for thought.
Yeah, Matthew, I don't think you've chimed in yet.
Yeah, well, that's a hard question because you said we can't really talk about any specific companies.
No, and if you want to name
What
specific, you can. Remember
No,
my
I'll
my
abide by
my
your rules.
constraints are different now. Yeah.
What I would say is that, we've been talking about certain points about, okay, there's certain companies that, well, a lot of companies, when the cost of debt goes down, they're going to be doing certain expansion plans. They may want to come to market. So if you can, there are companies that can benefit from some of the plans that some of these businesses have. So if you're looking at that, that'd be something that I would try to look into, say, okay, is there a company that can benefit if this company is doing this expansion plan? Or if even something like looking at some of the infrastructure plans the government of Jamaica is laying out. They're looking to incorporate as like public-private partnerships. So private companies, but the private companies could be buying from some listed companies, and they say, okay, they're buying some resources that you'd use in something like construction, or there's just so many things. I still think, if you look at the government of Jamaica's target, we want to increase our renewable energy footprint a lot. So there's a lot of different renewable energy companies that you could look into there. Um,
I
yeah,
wanted to talk about tropical mobility, but not this stream. Next one maybe.
Okay.
Yeah.
Yeah. So, and once again, same thing, buying value. So if I'm looking for companies that you expect heavy growth from, so companies that have big plans, but not just, okay, we say we're gonna do this in 3 years, but have they actually met previous plans before? So they said they had a, say, 2010 vision, and in 2000 or whatever, and then did they actually meet that plan? How did they meet that plan? Okay, this is a company that actually is able to follow up on what they do. So when they are now setting out this other vision or this other plan, I can say, hey, they may actually be able to achieve this. What could this look like in a year, 2 years, 3 years, or even 5 years? Yeah, and also, once again, look at companies that, well, I like to look at companies that the management of the company is essentially in the same boat with you as a shareholder. So they are earning money from the stock price or from the dividends of the company, not from something like management fees or they're almost like skimming off the top. So if the
Hey,
company,
are
yeah,
you throwing shade at certain companies,
no,
sir?
I'm not throwing any
Careful,
shade. I'm
be
just
careful.
saying at the end of the day, try to look for CEOs or even like something like seeing directors or management buying shares actively buying shares on the market. So they're saying, hey, this price that we're seeing, we believe this is a cheap price. We've already have lots of our money in it, and we want to even put more of our money in it. This is a price that,
Yeah,
because if
and
you realize that sometimes they know
yeah,
things you don't know. So if the price
yeah,
at 70 cents, 50 cents, whatever, dollar price, whatever, it looks good to them and they're actively putting their money in it and they're consistently buying more, there may be something to look in. Like that shouldn't be the only thing, like, oh, just because management's buying shares, I'm going to buy shares. But if management has been consistently buying shares, has been laying out certain plans, and they're even doing some companies sometimes with share buybacks, things like that. I think those are some of the things that you should look towards.
yeah.
And just
Okay.
Jermaine, just according to Jermaine, and see what the funny thing is, Matthew, you made a very strong point. And I remember talking to a friend about
I
this
fully
last
agree with
year.
Matthew, by the way. Fully agreed with him.
I was talking to a friend about this last year, he benefited from that, observing the director's position in terms of buying particular stocks. So for example, last year, March, before Trans-Jamaican Highways audited numbers would have been published, unaudited numbers would have been published at the time, but before the audited came out, a director, would have purchased quite a sizable position of Trans-Jamaica at $1.40. And when we all saw it, we're like, if this director is putting that much money in, something is going to
That says
happen.
a lot. That said a lot.
That said, it's a big statement because as the weeks
Yeah,
went by, you see it's going to $1.60, $1.70, $1.80. For the year is over, it's like $2.70. And the director sold those shares, a year later in March at like $3.10, $3.15. But a director that effectively benefited by, to the tune of probably 110, 120% in 1 year. And you as an investor could have glean from that direction or decision to buy the shares, as a indicative sign that hey, they're seeing something that we don't, and we can take advantage of it as well. And we saw a couple weeks ago where a director of TJ should have spent over $325 million to 800 million shares.
yeah,
So
yeah.
Matthew made
That
a
that
very strong point that management, being qualified, competent, and also involved is one thing, but where they are actually vested, you know, as shareholders as well, it's an entirely different ballgame because
yeah,
if a company is tremendously doing well, their net worth also increases.
yeah, for sure. I mean, there's I certainly don't want to feel biased. Don't want to seem biased, but I like certain companies for a reason. That's all I'll say. So let's take a couple of questions. We're gonna wrap up the stream in about 10 minutes. So we want to take your questions, especially those on Instagram. So let's alternate who responds. So when the questions come in, Matthew, you can take the first one, then David, then I'll take the third, and so on. So the first question is from Instagram. Julian is asking, and so this will go to you, Matthew. Are you allowed to share a few of the stocks you think are low now, or I guess undervalued now, in your
Am I
opinion?
allowed? Am I allowed, Jermaine?
Yeah, man. Yeah, man.
Okay. I mean, one of the ones that I think is kind of obvious, I guess I was kind of hinting at it. The Jamaica Stock Exchange itself. Maybe a lot of people maybe don't realize that they're a listed company on their own stock exchange. If you look at a lot of the points that we've mentioned and you understand how the Jamaica Stock Exchange makes money, they benefit from more companies being listed because it costs money to list. You have to pay certain fees. And then when you have more trading, they earn more money off of trading. And they have also been looking to diversify their income streams. Like, even though, for example, we mentioned that less trades have been happening and less dollar value has been traded, over the last, like, yeah, like last year and even this year, the trading volume and as a dollar value trades have been lagging. They if you look at just their profitability, the profitability actually hasn't dropped significantly, even though way less trading is happening because they've been looking into other methods to make money. So I think that interest rates dropping, bringing more people back to the market, more IPOs, more secondary offerings, the junior market limit getting raised, a lot of that kind of bodes well for the JSE. So that when that trading income
Are
comes
saying
back,
this because you featured the chairman? Is that why?
no, no, no,
Okay.
no, 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 no. But yeah, so that's one of the stocks that I would say is, I guess, undervalued, or another one, I guess, even uh, Wigton Wind Farm. If you look at that, they have been, so Wigton right now, or Wigton Energy, sorry, they produce like 60 megawatts of energy now. They have been pre-awarded in one of the government's requests for proposals, or the GPE's
Oh,
request
really?
for proposal. Yeah, they've been pre-awarded. So them and another private company, Sunterra,
Sunterra.
yeah, they won.
Ah,
Each of
okay.
them
Yes, yes. I think I saw
won.
that.
Yeah, I think it was like 10 or 12 other people or so that they beat out. So they are going to be building, or they're pre-awarded. So there's still some more processing to happen, but
Yeah, those things take a while.
yeah, but they likely, there's a chance that they can get then fully awarded. They can then set up this solar farm, earn 50 megawatts more energy. And the other thing is that there is another, the government has hinted that they are going to be asking essentially for more energy. I think it's 168 megawatts. So I'm
Correct.
expecting that Wigton would likely bid on that too. And their bid was actually very competitive. That's why they were pre-awarded. So I think that you look at something like that, that it's kind of the government's target. Um, Wigton will be able to essentially double or triple revenues possibly, or even something like Carib Cement. They still have almost a monopoly on cement production. Everyone's complaining about cement
For
shortages,
now,
and if you just look at if you look at the government of Jamaica's infrastructure plans, there are some massive, massive plans, and if what I
yeah.
said, it's almost a monopoly they have. They basically control the market. If they're not producing, we're all
Yeah.
in a
And
shortage.
I heard recently that
Mm-hmm.
a certain company, a government company, I won't say the name, will maybe doing their IPO soon. But let's move on to the next question. David, this one
Mm-hmm.
is for you. What do you think about iCreate's new chairman and the company wanting to change to a group? I know there's a lot to say re iCreate, so try and keep it 2 minutes or less because I want to take three more questions before we close out.
Who's the new chairman?
No, it's Tyrone. I think the person referencing new chairman because Ivan Carter would have been the chairman before, but no comment to be honest. I'm just no because what is there to comment on until there is tangible event that I've seen taking place? It's a bit relatively premature for me to comment because I create institute, still
They
trying to
still
get
have
back
the
on street.
institute?
They have the brand. They have visual vibes, 60% of it. Plan to list on the JSC junior market at a point in time. They have get paid. They're going to have a whole entire business now, still a loss maker. And while they, would be settling some of their liabilities and acquiring businesses until those businesses deliver and deliver at a pace that offsets the dilution that has come from issuing new shares, I just don't have any way to give sufficient comment.
I'd love to hear. I don't know if you guys know James Johnny. He does some really great videos on YouTube. Like he'll do months of research and then create this video that like tells a story about the thing. I wish
Mm-hmm.
James Johnny was in Jamaica to do a video on iCreate. I think there's so
You
much
should do
about
that
that
video,
story.
Jermaine.
No, I don't have the expertise because there's so much I think to that story. Just from I think general investors don't really understand. Uh, Honestly, I don't fully understand some of the things I've seen. One plus one is not equaling two in some of the things that I'm seeing, and I just think it'd be very interesting to see how things develop for them. I suppose I've been speaking to shareholders, getting some feedback. The perspectives are interesting, and I'm really curious to see what the next year looks like for them. So that's what I'll say. Next question, I'll take. Let me take one that I can answer. Humble Boss is asking, does a portfolio have to have a finance stock in it? I think that answer is obvious. I'd say no. I'll just say that the finance stocks are a good barometer for how the market is doing overall. So much so that I'll raise this point. Select funds, specifically Select F came out at a time where the financial sector was doing amazing. And I think that's part of the reason why that was even created in the first place, right? So that to me is a great benchmark for the overall performance of the market. So when we start seeing those stocks recover to even early 2020 or 2019, 2018 levels, then I think it's safe to say that we're back in full swing of the bull market now. It may not happen exactly where they're all moving together at the same time. It may be one and then the others follow. Of course, if it's just one, I have a few candidates in mind who I think would be like a first mover. But I'd say short answer no, but it's a good industry or sector to watch in terms of just overall market performance. All right, let me give you this one, David. So thank you for your honest opinion and accurate. Let's see. This question is specifically for David. How do you calculate the intrinsic value of a company? I would really appreciate the formula. So Glamour, are you saying it's only David alone can answer that question? I don't understand.
So
me and Matthew are value investors too,
No, David's the guru.
nah, I'm not a guru, but there isn't a specific formula all the time because different companies require different methodologies to value.
Exactly.
So let me tell you why I say that. So, for example, a Carreras, they pay out all of their profits as dividends. You would not value a Carreras who pays paying out all of their profits as dividends the same way you would for, let us say, a manufacturing company like Cinco, which keeps a particular amount of cash on hand to give them space for potential acquisitions or expansion, and similar for finance and other sectors. So you can use, your discount, the dividend discount model. You can use the discounted cash flow, but it comes back down to also the nature of the company and how the group of companies also, earns or derives its earnings as well. Because if it's the case where some of the subsidiaries of the group itself is not paying dividends up to the parent, or the parent not pulling any income off the subsidiary, whether fees or anything else, then in that case, they might have a lower valuation if you're doing a sum up or a sum of the parts kind of valuation. So it's not a hard and fast kind of approach, but as I said, there's a specific formula, but it depends on the company itself as well. There's a question that Roswell, a comment I think Roswell made at 10:30. If trade fees low, how does it affect the JSC? I don't buy there. So just for context, so people can appreciate it. When you buy or sell a stock on the JSC or the transaction on the JSC, there are 4 fees. Well, 3 sometimes, but basically it's really 3 in essence. Yeah. So you have your commission, which goes to the broker. You have the JSC fee, which is 0.35% of the trade value, and you have the GCT, which only is applicable to the commission and to the JSC cess. So when somebody is buying a stock and the seller on the other side is also in their transaction, the JSC earns part of the amount that is traded from both parties. So the party that is, buying the stock pays that cash up front. The party selling the stock has that amount deducted from their net amount that they're going to get. But if the value of the equities on the market has increased and continues to increase, even if there are less trades, the JSC's fee income actually can be relatively high or stable. If the value of securities goes down, if there's more trading, the Jays can earn this in fee income because they're earning earn a same percentage or a small amount of value that has traded.
All right, thanks for that, David. I think that's it in terms of questions. So let's take final comments, guys. Any thoughts, any final thoughts on the interest rates going down, how you're positioning yourself, etc. Just like closing remarks. We're not starting any new conversation. Right? Closing remarks.
So for me, the way I see things right now, rates coming down only means opportunities abound.
Yeah.
How you take average opportunity, that's up to you and your advisor, or how you decide to build your portfolio. But just be very considerate that when rates do come down, the value of assets tends to go up, not just stocks, but other assets. So if you
Yeah.
see a car or you see a house you want to purchase, you can always buy it today and refinance it in the future. So if you borrow 10%, you can always refinance at 8, 7% in the future and save on your monthly costs. So you don't have to be shackled or handcuffed in that context, in the future. So
Yeah.
that's just my perspective.
Matthew?
Yeah, I mean, the my perspective hasn't really changed that much. Once again, he's still trying to buy a business or a company for less than it's worth. The interest rates falling doesn't really change that. I guess that generally will lead to more people investing in the stock market. But the time it may take some time for that to happen. So at the end of the day, I'm still investing. I'm not gonna stop. When it happens, it happens. Yeah, that's my take.
All right. And yeah, I said most of it already. I'll just close out by saying that you always want to be investing consistently. So you want to remain invested, right? I think with the great opportunities we still have, I think the dividend play for stocks, in terms of that being a focus, will remain for a little bit. At least I'd say the next 3 to 6 months, we'll still see some very attractive yields. And I think that we've already started to see, because when I checked my portfolio, I don't check it as often anymore. When I checked it today, I saw where there was a stock that I had that I was in losses for quite a while. And in just this maybe last 30 days, I'm up a good amount. So I was very happy to see that. That's a trend in the right direction. And I'm not worried about the US markets as much. We didn't talk about that much here today, but I'm kind of waiting to see how things settle after the elections, honestly. But I love to see the trend of interest rates going down across the board. And I look forward to the opportunities that are there. Now, if the market recovering means everything, goes off and we have a bull market, I'll be extremely happy because I've been building up positions in companies I think I could hold for the next 5 to 10 years. So I think I'm good now. There was one company that I'm in some massive losses for. The loss is so ridiculous. I don't know if it makes sense to even sell. One day I'll
You want
tell
to say
that
which
story.
company?
Huh?
You don't want to say which company?
No, but I think when the market recovers, it will. So I have good volume, and that's the only reason why I'm holding. So selling now for the cash I would get,
Mhm.
I haven't seen a compelling enough opportunity because I'm not one that holds forever, right? I'm willing to take a loss. Haven't seen a compelling enough opportunity to sell, but
Mm.
it's a good time to invest. If you don't know how to invest, that's what Learn Grow Invest is here for. This is the part of the program where I do the plug. So I'll say thanks to you guys first, and then I'll do the plug. But thanks, guys. Be sure to check out. Let me share the link that Matthew shared with me. I'll ask you, Matthew, to just comment under the video, and we'll pin it. All right.
Okay, awesome.
So check out that interview with the JC chairman. Check out Limitless Podcast YouTube channel. They're road to 1,000 subs, right, Matthew? So I think you're at like 620 now.
Yeah.
So watch
yeah,
the
something
video,
like
not just subscribe, because they need that watch time as well to get monetized and good stuff.
Thank you.
All right, guys. So thanks again. All right. So Humble Boss, I'm so sorry I missed your question. What do you think about CPJ new management? You mean the AS Bryden? Is it AS Bryden purchase? I haven't looked at them. That's the last news that I saw. Hopefully that's the one you're referring to. Let me address that one next week, if you don't mind. All right. Let me see. If I don't check my portfolio, I don't make money. Live trades, not just waiting. That's okay. Sebony should have two. Okay. okay. All right, guys. So you're just kind of talking. Let me check Instagram. I think we're good. So, guys, thank you so much. I didn't know how many persons would join tonight. It's a little bit late here, but because it was a Friday, I thought it would still be worth a shot. For those watching on the replay, thanks for watching this far in. For those who don't understand investing, want to learn how to invest, we do have one-on-one coaching, investment consultation, group coaching. We have our investment challenge that's going on until the end of the year. You can still join that challenge. We have 3 solid months to go. You'll get access to all the sessions that you missed, and this can really prepare you for investing for 2025. Our one-on-one coaching sessions are fully booked, so we're not taking any new persons in that right now, but that will change come January. We'll have some slots open then. So if you are interested in one-on-one coaching, send me a DM. Send us a DM at Learn Grow Invest, or email us. Join our mailing list. You'll see those emails come out when it's open. And yeah, thanks for watching. I'll see you in the very next video.